Retirement savers, what's going to happen next? 2020 should have taught us to expect the unexpected. Pandemic problems took their toll. Government shutdowns, excessive money printing, soaring inflation, surging energy costs, and then Russia invaded Ukraine. These events led to empty shelves, rising interest rates, a possible recession, and asset volatility. It's rough on retirement savings because the buying power of your dollars has shrunk. What domino will fall next? No one knows for sure. What you should know is that you can prepare. If you have saved for retirement, learn how to diversify with a physical gold and silver IRA with our free guide. Don't miss this opportunity to be included. Hall of Fame quarterback Joe Montana became a customer and our corporate ambassador after he got the same information. Please learn from his example and get your free guide today. Are you worried the Fed might move toward a U.S. digital dollar and get more control of your IRA or 401k? The value of money has been shrinking, in part due to the Federal Reserve's inflationary actions. The fact is, Washington has been exploring a digital dollar currency system which could give government greater digital access to and control over your money. We'd like to show you what's going on. In this guide, we offer surprising, behind-the-scenes information about the digital dollar and our economy. Don't miss this opportunity to be included. Hall of Fame quarterback Joe Montana became a customer and our corporate ambassador after he got this same information. Please learn from his example and order your guide today. Looking to open a gold IRA? Stop right now. Buyers beware. Gold IRAs are unregulated. Gold IRA companies are not all alike. Some use lies, gimmicks, and high-pressure tactics like the excessive free silver scheme to push you into starting a gold IRA with them. And that's wrong. With one wrong decision, you could be facing large hidden charges that reduce the value of your funds for years. Let us help you avoid a costly mistake. You can easily learn how to avoid falling for those scams by getting our guides, 10 Gold IRA Dealer Lies, and 15 Bad Reasons to Buy Gold and Silver. If you are looking to do a gold IRA, this is a must. Click here to get the guide and find out how to get a gold IRA the right way. Inflation continues to be an expensive problem for Americans. But could an even bigger problem be lurking? Welcome to Economics Made Simple. Higher prices are everywhere, and everyone would like to see them go down. But for that to happen, history tells us that a significant economic downturn, a recession, may often be necessary. How does inflation lead to recession? Fortunately, Clint Dahl is here to explain. Clint, thanks for joining us. Can you please explain how inflation leads to recession?
Throughout history, recessions have often marked the end of high inflation periods. Here's how that can happen according to both history and economic theory. The Federal Reserve ideally likes to see a little inflation in the economy, about 2%. It's a balancing act. The central bank views 2% inflation like this: high enough to represent economic growth and low enough to not erode consumers' purchasing power. If inflation starts to creep above 2%, the Fed will begin this period of watchful waiting. They'll give inflation a chance to clear up on its own before taking action. They watch to see if inflation drifts back down on its own towards the target level. The Fed has frequently done this when it appears that the cause of inflation may be short-term events, unrelated to economic or monetary policy. However, there are times when inflation has moved significantly above that 2%. This is when the Fed will pull out the only tool that it has to fight inflation: raising interest rates. These interest rate hikes are designed to reduce inflation by raising the borrowing costs for consumers and businesses. As these costs rise, demand for these goods and services will fall. The problem with the rate hike tool is it tends to be big and clumsy. It's kind of like trying to kill a fly on a glass table with a baseball bat. Only the perfect amount of force will kill the fly without breaking the glass table. In this sense, the Fed has to raise interest rates just enough to fight inflation, but not cause a recession. Unfortunately, that near perfect application of rate hikes is hard to accomplish. Experts have noted that of the previous 11 rate tightening cycles, 8 have ended in a recession. In a future video, we'll take a look at a different economic situation, where we have both high inflation and a slowing economy. This is called stagflation, and it's thought of as the most perfect storm for an economy to impact it in a negative way.
We look forward to that, Clint. And we appreciate your explanation today of some reasons inflation may have so often led to recession. That's it for today's lesson. If you enjoyed this video, be sure to hit the subscribe button and check back often for more Economics Made Simple.
Joe Montana here. Click subscribe now and hit the notification bell to stay up to date. You'll be glad you did.
In our last video, we covered the meaning of a recession. For anyone that's been through it, a recession can be hard. Like many of you, when I think about recession, I often wonder what impact it would have on my life savings. So today, we're going to answer that question and many more. Welcome back to Economics Made Simple. To help answer our question, we've brought on Clint Dahl. Clint, can you please explain how a recession could impact our life savings?
I'd be happy to answer your question. How does a recession impact our life savings? A recession can have an impact on your savings no matter what stage of life you're in. A quick reminder from our last video, a recession means that there's an economic slowdown. In other words, the economy is shrinking rather than growing. In a shrinking economy, the unemployment rate can rise. And someone who's out of the job can no longer contribute to retirement savings and may even have to tap into their savings to cover bills. Companies facing lower sales are forced to make cuts. The easiest cut to make for a company is labor. And older workers typically tend to make more than younger workers. So a company will save more by laying off an older worker than a younger worker. This then makes older workers have to delay their retirement to make up for the lost wages and savings. According to Stanford, in the 2008 recession, the unemployment rate for men aged 62 and older increased by 4 percentage points, an unprecedented surge over the past 35 years. The impact on savings for those already retired can be just as severe. Retirees typically rely on a variety of savings and investment to cover their living expenses. Investments usually consist of a mix of stocks, bonds, or cash. A stock market correction can be painful. Markets historically correct about 15% every 1.5 years. However, the difference between a minor pullback and a major bear market can be if that correction coincides with a recession. The average market correction during a recession is 36%. This has obvious implications for retirees who have their portfolios in the markets. The other part that is equally as important but less discussed is in savings and bonds. Retirees will typically shift their portfolios to have more cash and bonds than stocks. One of the main tools used to fight recessions by the government is to lower interest rates. They do this to encourage more lending and investing to generate more economic activity. Those with savings also rely on interest rates to generate cash flows to cover their living expenses. By lowering interest rates, the cash flows will also go down. That would hold true whether you're invested in bonds, CDs, money markets, checking and savings accounts, or cash. Fortunately, when it comes to recessions, the anxiety that we feel can be helped by knowing that they will come eventually, so we can take steps to prepare beforehand.
Thank you, Clint. With your explanation, I now understand how bad a recession can be, especially if you are retired or retiring in the near future. Let's hope we don't get into a recession anytime soon. Well, that's all for today's lesson. If you enjoyed this video, make sure to subscribe and check back often to learn more.
Joe Montana here. Click subscribe now and hit the notification bell to stay up to date. You'll be glad you did.